Good afternoon, everyone. My name is Peter Suarez Ferrara, and I work for UBS as a technology investment banking director based here in New York, where I cover financial technology and digital asset companies. Our topic today is integrating stablecoins into the global payment stack. Stablecoins are one of the most important developments in financial infrastructure over the past several years. Stablecoins have evolved from a crypto trading instrument into a rapidly growing settlement layer for cross-border payments, treasury management, and on-chain financial markets. The question today is no longer whether stablecoins work, but how to integrate stablecoin into the global financial system at scale. We're fortunate to have leaders representing both TradFi and crypto-native innovation to discuss where stablecoins fit into the future of global payments. To start, we'll have the panelists briefly introduce themselves. James, would you like to begin? Austin, you want to go?
Let's see if I'm turned on. All right, we'll let James figure it out. So I guess I'll go first. So hi, everybody. I'm Austin. I have the misfortune of being on both the traditional financial side and the crypto native side. I've been at many of the large banks. I've used to run the third largest stablecoin in the world. I'll jokingly say my claim to fame is that I built one of the two that went above 20 billion and back to zero, and I'm the only one who didn't lose anybody's money or go to jail.
That's tough to follow up. Lauren Berta, I'm from Ripple. I'm the product lead for our stablecoin business, namely RLUSD. 1.5 billion today. We're a top 5 fiat-backed stablecoin. And yeah, my background's in liquidity products, tokenization. Yeah.
Hi, I'm Tom Zschach. I'm the Chief Innovation Officer for Swift. I don't refer to that as traditional finance. It's just finance. It's kind of how things work today, and there's a lot of momentum to make that better. I've been in that role now for 6 years. I'm based here in New York. We're headquartered in Belgium, but I work out of the New York office. Prior to the 6 years at Swift, I spent time at other market infrastructures, the CLS, which is the FX settlement utility and London clearinghouse for derivatives. So over 15 years in financial market infrastructure. And I have to say, I'm really happy to see these kind of conferences happening and happy to participate, to really be really clear about this track, which is the institutional track, which is very different than retail, and we're going to get into some of that today.
Hi all, I'll try again. Is that working? Yes. Great. I'm James, co-founder and CEO of T0 Network. So we're a stablecoin payment network for regulated institutions. We enable financial institutions to execute correspondent payments globally and then settle those with stablecoins. So our network now spans correspondence in 50 countries, enabling over 1,000 cross-currency corridors. And our model is very much based on separating the clearing of a transaction, which happens in the fiat currency, from the settlement itself, for which we use stablecoins.
Perfect. Let's jump right in. So stablecoins are often positioned as a faster and lower cost alternative to legacy cross-border payment rails. To set the stage, how should we define the role of stablecoins in the global payment stack today? And what measurable advantages do stablecoins offer relative to existing infrastructure? And beyond regulation, what structural barriers are preventing mainstream use? Tom, you want to kick us off?
Yeah, it's a good place to start. And as I said, I'm happy that we're talking about the institutional aspect of here. And excuse me, and when I attend conferences like this, I think it's really important, and I think people quickly agree that sending $50 is very different than sending $500 million cross-border. They're just completely different. They're just completely different constructs. There's different expectations, and today you see the demand for digital money, right? There's $300+ billion of value on chain. Most of that is on Ethereum, but it's real. There's real demand for that. And in terms of retail, if you're paying a relative or a friend in Lagos or Manila or someplace where they're friendly to dollars and they want dollars, that's great. And it removes a lot of friction. And you can do it really fast, and you can do it very inexpensively. There's some things that the other receiving side has to understand in terms of wallets and that sort of thing. But it's demonstrated to work. The technology works. The friction's removed. All of those things happened. When you get in the institutional space, it's actually a different kind of problem, because it's not just about doing things faster or cheaper, right? We move messages around the Swift network, 50+ million messages on the Swift network, and we move that in seconds. It basically travels at the speed of light. So that's not where the bottleneck's at. And if you ask people in the institutional world, what do you need? They don't say, I need faster pipes. They don't say, that never comes up. In the 6 years I've been at Swift, nobody's ever said that to me. What they actually need is certainty. What they actually need is to be completely compliant with the law. What they actually need to do is follow their policies. What they actually need to do is understand if they have a problem between jurisdictions, and when I'm making a large payment to Singapore, what happens? Do I litigate in Singapore? Do I litigate in the US? All of these things have to be predetermined. And again, 50 million is not 500 million. So for institutions, and I would include regulated financial institutions, banks, large corporate treasurers, for example, it's about governance and control. And yes, they want it to be fast, and yes, they want great service, but that's really what it's anchored on. And I think, I think the stablecoins do allow a lot of those friction points to be removed. There's no doubt about it. And I personally think that, and what I see and experience from banks is that banks will find a way to use stablecoins. We've seen some pretty good progress in the area, but I do think they'll use it along with other kinds of assets on their balance sheet and things like deposit tokens and tokenized deposits for their own networks.
Austin, you want to jump in with anything else?
Yeah, I guess the other thing I would say is crypto in particular has had a problem with oversimplifying some of these frictions away, as Tom was saying. Institutional use cases are also incredibly varied, and some of them do not fit well onto the current structure of stablecoins, right? Like a good example is like net settlement end of day on credit card networks. I don't really want to push 25 billion of real-time gross payments to net settle $12 million at the end of the day. That's a tremendous amount of effort that's basically wasted. The other part, though, is I would say the institutions are more credit sensitive and more yield sensitive than the average person that you're going to deal with in retail. So like really small nuances from a retail perspective will actually drive institutional adoption. Tom, we've talked about things like derivatives usage. There, you're going to want a stablecoin that literally can only be created and redeemed in kind with T-bills, like no bank deposits anywhere, to avoid the credit risk. And so I think we've been insufficiently granular in this discussion as well. And if you really want to understand it, look to the problems, not just the token.
Perfect. Building on the topic of institutional adoption, as institutions evaluate stablecoins for payments, treasury management, and settlement, what aspects of stablecoin design and implementation are most important for driving institutional adoption? Lauren, do you want to start with this one?
Yeah, so when you're designing a stablecoin or choosing which stablecoin to use, you want to think about trust. What brings trust to the different parts of your business, right? Your liquidity team cares about different things than your tech team and your compliance team. And so when you're talking about designing a stablecoin, okay, what drives trust for everybody? How is the reserve managed? When you're looking at different stablecoin issuers, you want to make sure, the regulatory sort of management of the issuer is, as structured as possible. You want to trust, or under Genius, it'll be some sort of trust in the US at least. And then when you give into reserve management, you're going to want to make sure that reserve is monthly attested by a Big Four or some sort of accounting firm that you know well, and that those reserves are all cash or cash equivalents. When you get into looking at a stablecoin for your daily use, you want to make sure that dollar is really going to continue to be a dollar, and much of that comes down to the reserve, as said, and then also sort of mint burn speed, how quickly can you redeem? That's going to come directly from the issuer for most institutions, and so you want that to be as real time as possible. And when you go deeper there, you'll want the same sort of at the distribution level. You'll want as quickly as possible for whatever partner you buy or redeem your stablecoins with. On the compliance side, it's really important that your stablecoin issuer is tracking, the sanctions list, SOFAC, pre-freezing to make sure that no sort of the issued token ever touches a sanctioned entity. For RLUSD, we do this preventatively in an automated way. We're tracking that list constantly and making sure all of those wallets are frozen. And with that, you want to make sure your issuer has that capability of freeze and clawback. This is, again, required in most trust structures and under Genius. And And then I think the third thing I'd talk about, DPEG risk is a bad word generally for issuers. That's the product. It should be $1. You want to make sure you're working with an issuer that has that liquidity experience, liquidity management across such a wide distribution of different venues that these stablecoins are being tracked for price on. Ripple, for example, has been managing this type of liquidity in our payments products globally for a decade. And so we were lucky to have this experience for free. But I think it's something that is constantly overlooked when somebody gets into the issuance of a token, because especially during the growth period, it's quite a large, data-driven undertaking, and you really need that mature experience to drive that trust for institutions.
Yeah, I would agree with a lot of that. When we speak to banks and institutions who are coming to us working with stablecoins for the first time, we talk about the issuer being a new counterparty. So you've got to think about the stablecoin issuer, perhaps how you'd think about a new large correspondent relationship, and you've got to do due diligence on that issuer. You've got to understand their business, how long have they been in the market, how big is their balance sheet, and you've got to understand the structure of the stablecoin itself and the reserves. What I think is really interesting, though, is that in the paradigm of stablecoins, you can manage that counterparty risk in much more fine-grained way than you might be able to with other traditional types of payment correspondence. You can decide how big a float in that particular stablecoin you want to hold for any amount of time. You can have a large float in the stablecoin, which will facilitate simpler treasury operations, and that might suit your balance sheet, and that might suit your business model. Or you might want to reduce that exposure to that new counterparty and that new correspondent by enabling more just-in-time conversions in and out of your stable coins for your payment operations. So I think the way to think about this is you get much more ability to manage that counterparty risk in a way in which other types of relationships, you can't manage it to that level.
Perfect. Tom, anything you want to add from Swiss perspective?
It also, just in terms of adoption, it needs to fit into the flows that the customer is going to have, right? Whether that's a corporate or that's a bank dealing with another bank, it needs to fit into the flows that they already have. So one of the thoughts, and I'm not sure how many blockchains the Ripple stablecoin's on, but I do know Circle, for example, is on 23 or 26 different blockchains. In the corporate world, somebody can't just see $10 million show up in their wallet. Like, where did that come from? Where did that, which one of the 26 different blockchains did that come from? What was the transaction ID? Did it include compliance things like the travel rule? Was any PII information written on the chain when the transaction was recorded on a blockchain? And how does it actually flow into the ERP system or other systems I use from Oracle Finance, for example, that I use inside of the corporation? All of that integration matters. The last thing that the operational part of a corporate treasurer is going to want is another spreadsheet to reconcile. Right, so that whole, when we talk about the adoption, the integration, we always like to talk about the build, but we never like to talk about the run and the operate. And I think, for people who work in even medium-sized or large institutions, nobody's looking for a new workflow project with everything else that's going on. So you have to kind of break down those barriers as much as possible, and it has to be transmitted in a way that not only can they take it easily, but then it kind of ticks all the boxes for, again, going back to the risk points that were made earlier.
Yeah, just to build on that, totally agree. We spend, as an issuer, most of our build time on that connection point between the fiat and crypto. I think many people believe that an issuer is spending all their time on smart contract audits and making sure you can actually mint the token, but honestly, that is the easy part. The blockchain allows you, because the data is so accessible and reliable and you always know exactly all of the parameters of the transaction you will receive, and that does vary by blockchain for sure, but when you get into that kind of management of operations, it's very easy to really take your transactions internally and label them yourselves. Now, that is a build, I totally agree. But it is a build that we used to try and help customers when I was at Citi with, and there's a great product called multi-bank target balancing via Swift, where basically you can pull your balances from 3 different banks into your end of day or into your bank account at Citi or wherever you are going. And that kind of product is something you would rely on your tier 1 bank to provide to you in the fiat world. Where in crypto, it's something you could build yourself. And I think with Ripple Treasury, for example, I, again, totally agree. These things have to, it's just another payment method. It needs to be brought into your daily flows and match what your accounting team is expecting across the board, information and metadata-wise. But what I'm really excited about with stablecoins is how easy that is to build internally, because like you said, it's super different company to company.
In some ways, though, many financial institutions are sort of among the worst situated in the world to solve this problem quickly, just because the information landscape they're used to dealing with is not the information landscape that you existed on blockchains. Right, and what I mean by that is, like Tom referenced the travel rule earlier, which is a rule that makes sure as money moves from entity 1 to entity 2 to entity 3 to entity 4, we have a consistent chain of events so we know where the money came from. That's the travel part of the travel rule, right? Okay, this makes total sense. Well, if you already knew who all of those people were without having to ask because you had different data sources to target them, you wouldn't need the travel rule. And the problem is blockchains, when combined with other data sources, move us from the traditional bank KYC world to the world that, say, Google and Meta live in. And let me tell you, they know more about people than the banks do, right? This is not a controversial statement to anybody either at Meta or a bank. And I think what's really damaging to people in this space from a process perspective, because Tom is completely correct that process integration has been hell for a lot of the big banks, you know, big asset managers, et cetera, is that you're not just having to rebuild internal processes, you're having to rebuild mental and strategic and data models to really take advantage of this.
Shifting to the topic of regulation, with the Genius Act in the US and MiCA in Europe, formal stablecoin rules are taking shape. However, regulatory fragmentation remains and clarity is still often cited as the biggest barrier to stablecoin adoption. Are these new rules accelerating institutional adoption of stablecoins and cross-border payments, or creating regional silos that limit global scale? Austin, you want to start with this one? I think you have some strong opinions here.
Yeah, I mean, I guess the answer is integration between rich regimes, because the answer to your question is yes. Both. For instance, if you look at Genius stablecoins and you look at MiCA, they might be mutually exclusive, which that's not actively helpful for cross-border payments unless we establish some sort of reciprocity. Here's the reality. The views of regulators and governments on this are not uniform, and the incentive functions that they're dealing with are very different. If you are a small to medium-sized sovereign in global markets, like outside of the G8, US dollar stablecoins are probably an existential threat to your existence. And so their view of that are going to be very different than, say, the Eurozone, where I think the euro probably continues to perpetuate. The other problem here, and Tom was alluding to this earlier, is the granularity of what do we even think we mean by like money. Genius is a good example of this, where they define stablecoins as essentially an instrument attempting to hold a $1 value on a blockchain. And then you go and read it, and there has to be a list of like 20 different things that are exempted from that because they're doing the exact same thing, but they don't want them in that framework, like tokenized deposits. And then elsewhere in the text, maybe didn't think about that, and so some weird interactions are happening there. There's going to be a lot of teething. So is this accelerating institutional adoption? Yes, but you need to be specific on a use case by use case basis. None of these frameworks cover all possibilities.
Yeah, I agree. It's definitely helpful to have clear rules of the road, so that institutions in both markets can understand what needs to be done and what good looks like in order to participate with this new technology. But the real value proposition of stablecoins is that the sending institution in one country can send that cross-border in seconds at a very low cost to another institution in another country in settlement of a liability. And if those two countries have different regulatory regimes and the same stablecoin can't be used because of regulatory fragmentation, then that really undermines just the core thesis and value proposition of using these things for cross-border. And I think we're already seeing that with, so Austin pointed out, in the MiCA regulation, MiCA requires the reserves to be held in European banks, and that's designed to protect the European banking system. But that means if you're a global stablecoin issuer operational in lots of different countries, and for a company like ours who wants to use a stablecoin to transfer value in lots of different countries, that fragmentation is very unhelpful. You have to have a very specific reserve mix, specific operating model just for one market. And I think that is a problem. And if regulation develops in a similar way in lots of other markets who are taking notes from both Genius and from MICA, that could be damaging to the overall value proposition. And I'm hoping regulators can get their heads together and really think about that.
Tom, you want to add anything else? Tom or Lauren?
I mean, just in terms of regulation, I was in Washington last week at the DC Blockchain Week, which is a fantastic event. And it's pretty clear we have a real tailwind from the regulation, from the Genius Act, from MICA. There's a similar stablecoin bill in Hong Kong, for example. And so all of those things matter, but step one is legislation. Step two are the rules by the people who've been designated the regulators for that. In the case of Genius, that's at a state level as well as at a national level through the OCC. Those rules have just been published and out for comment, right? And again, it goes back to my certainty point. Corporations and financial institutions are not going to use any kind of asset, including new forms of money or digital forms of money, unless they're certain on what it is. Unless they're certain what rules do we play by. They're not just going to say, I'll just put $5 million in my balance sheet and see what it turns out to be. Like, nobody's doing that, right? You need the clarity. We're making really good progress on that. Congress is working together very, very well. They had different agencies, CFTC and FDIC, I think are part of this conference as well. They're committed to it, and they'll get it right in the U.S., and I think that'll be a catalyst for the rest of the world. And then it gives you an environment where it's ingrained in law. It's not going to switch with a regulator or an administration, and people can get back to certainty, which is what you're going to need in an institutional environment.
Lauren, how does Ripple look at a regulatory landscape? Is it a tailwind, headwind?
Yeah, like everyone said, the tailwinds are strong. So as an issuer on the Ripple side, we take a really conservative approach to regulation. We work very closely with our regulator, the NYDFS. On top of, we've now been approved for an OCC bank charter, and so we'll be doing the work there to make sure we're adhering as needed. I think as a builder, maybe stepping back from Ripple, I've been building in crypto for 5 years. We've watched different firms take different stances on how liberal or conservative to go, and we've seen some firms be burnt. We are hopefully past that, but yeah, I mean, I agree with everyone. Like I said, as an issuer, we take a very conservative approach, and we want to make sure we are following the rules and innovating within guardrails, and that is what's best for our customers.
I'll say, though, I understand everybody on the institutional side says that. There are some people who are going to push the boundaries, and this is going to create some problems for regulators, especially as we get outside of the jurisdictions that have had really good rule of law. So like Tom, operating from Belgium or operating from the United States, you're within systems that, to be honest, have largely worked properly. But if you look at global stablecoin distribution, like if your other option is, I don't know, the Bolivar or something like that, like locally, you might take a yo on Tether, right? And so one of the other things that regulators have to realize is all people need to get a US dollar stablecoin of any form is the internet and something of value to trade for it. So if your local system is worse than that, you're gonna lose, right? This is something where people will be dragged along by the technology, kicking and screaming, in some cases voluntarily leading in others.
Great. So now that we've discussed stablecoins' value proposition, institutional adoption, and regulation, if stablecoins achieve global scale and cross-border payments, which institutions or revenue pools are most exposed to margin compression, and which business models are best positioned to capture the most economic upside? Tom, you want to take this one first?
Yeah, I like the business model question because sometimes this is not fully understood or gets conflated. And sometimes when we say a bank, whether it's Citibank or something, these are large, complex organizations do many, many things really, really well, right? So one of the business models they run is the corresponding banking business model. That's high-value payments cross-border. Those are important payments. If they don't happen, then money gets stuck someplace it shouldn't get stuck, or somebody who's relying on those funds to do something with that doesn't get their money, right? So with the larger the value and this kind of the corresponding banking business model, again, it's very different than retail. But another thing that's really important to consider is that the banks that are on SWIFT, the correspondent banks that are on SWIFT, actually compete with each other every day on SWIFT. So think of SWIFT as the network where the corresponding banking business model is run, and that's where large value institutional payments are done today. So how does when we talk about the business model, how does a corresponding bank make money? Right? There's three ways of doing it: foreign exchange, obviously cross-border, right? They keep float or get interest on the Nostra Vostra accounts, which are gigantic, right? There could be, I know, estimates of $10 trillion in Nostra Vostra accounts on any given kind of normal day. And then they make fees when they intermediate, right? When you instruct a payment here through your U.S. bank and they have a relationship with a bank in Japan, for example, somebody's going to collect a fee along the way as that money moves around. So the thing that's really interesting is that the banks didn't actually create these as products. What they did is they actually used the settlement systems that were there, that have been around for decades, and they monetized it. Right? So when you talk about the business model, the banks are just monetizing what they have to settle money. Now today, every place that money is settled, it's either run by a bank consortium or it's run by a central banks and the commercial banks participate in it. Everywhere in the world has one of those two models. And I've worked in some of those places, right? So that's what's happening. Right now, we have $300 billion of value in US dollar stablecoins. Who owns Ethereum? Right? So we haven't, when we talk about genius, we talk about issuance, but we don't talk about settlement yet. Right? So again, the business model is not fully fleshed out because the corresponding banking business model pre-funds and gets ready for large value settlement. We haven't started talking about that yet. There's no kind of definition for how that's supposed to work. And so I think what's really kind of interesting here is that the banks are depending on friction that they didn't create, but a lot of that gets resolved with stablecoins. I'm not sure exactly how that plays out, but we know you can move a stablecoin for some cases, and it's fast and it's cheap and it works really well. Right? So you have this friction in the system and the economics that are tied to that, some of which can be resolved with stablecoins, and corresponding banking is going to be challenged on that. So the banks aren't going to just sit around and wait for that to happen, right? They're going to have similar offerings with deposit tokens, which is where we're starting with the Swift Ledger, because they can actually create a token that points to reserves they have at a central bank. And they can move that very, very quickly, and they're very interested in doing that, right? So banks, are very, very acute. They see the changing market, and they see that they're going to have to do some different things, and they're not going to drop the bar in terms of the quality of services that they offer to their customers. So, and I do think they, again, as I said earlier, I do think they are going to start to use stablecoins. So the economics of this are going to shift. The risk of some of these things are going to shift as well. Right? Sometimes we look at the opportunity and the business model that's out there, but what risks are going to be introduced, whether that's credit risk for the issuer, whether that's liquidity risk for having the money where you need it at the right time. All of these risks have to be factored in, and they're all done inside of a fairly well-known and mature regulatory framework for liquidity, for capital management, for those kind of things. And the banks are in the process of kind of evolving what they do to take advantage of the new assets that are out there.
I think some of it you can look structurally at who the users are, right? Most of the adoption of US dollar stablecoins is by non-US persons, right? And that means that the transaction path is coming from a foreign currency into something either dollar denominated or that you can get into dollars. There's a lot of what's called the stablecoin sandwich, which is local currency to something like Bitcoin to a US dollar stablecoin. But fundamentally, you're going from FX into a US dollar stablecoin. The US dollar stablecoin is created with a bunch of reserve operations in the United States. And so if you look at those two legs, who are the winners here? One, global rates divisions at most of the large US banks. If you're a JP Morgan, a Citi, a Bank of America, et cetera, your tradings volumes are going up. You're going to be trading more T-bills. You're going to be doing more repo. This is a good thing for them. Two, US dollar deposits in general have greater demand. The people who are losing are euro dollar deposits. You can really think of stablecoins right now as taking dollars held outside the US and bringing them back into the US system and then allowing them to trade globally. So we're looking at a reordering between, call it dollar deposit accounts outside the United States versus inside the United States in terms of value. That will favor some banks over others as well. The biggest losers are probably, as Tom was alluding to, the friction points that have been making money off of purely being a friction point because of that process.
Yeah, not to put too fine a point on it, but we speak to regional banks in emerging markets pretty much every day, and their interest in using our network and stablecoins for settlement is not just lower FX costs and speeding up that settlement time. It's actually liberating balances from offshore accounts and putting that capital to work elsewhere in their business. And that's a major driver, predominantly from regional banks. So we're seeing that actively.
Yeah, and just to add, I think a clear winner is, again, the many regional banks across the world that maybe don't have access to SWIFT. The SWIFT network, totally agree. Correspondent side, that will definitely get squeezed and change, and the banks will definitely keep up and continue to provide good support for their users. But for regional banks, a SWIFT integration, maybe hasn't happened for them yet. Utilizing a stablecoin might be a more interesting integration to start with, just for the sort of future-looking effects.
Can I add one thing to that? Because I talk about this when I come to DeFi conferences. Sometimes I'm in the audience and I listen to a founder of a new digital custodian or somebody who wants to provide, payment services, liquidity services to financial institutions and banks. And I'll go and introduce myself after the session, and sometimes they make comments about corresponding banking or SWIFT or something. So I introduce myself, and I say, you just sat on the stage and said your target is to get to financial institutions. How can you not be on the SWIFT network? Just want to understand your strategy. Like, we're literally connected to everybody, every place in the world, right? And sometimes that's intermediate or not. But I go up to him and I said, well, how can you, how could that be your target and not be on the network that all of your target customers are on? And most of the time, I get pretty good answers. Right? I think I get good answers for that. But that's actually built a real pipeline for us. And we see a lot of the new digital entrants that are getting registered, that are getting licenses, the charter banks, they're all joining SWIFT because it's the fast track to institutional finance, and it gets you connections over 11,000 endpoints immediately. And it's faster than you think, and it's cheaper than you think to get on board.
So looking ahead the next 3 to 5 years, beyond regulation, what will be the key drivers for stablecoins to become an indispensable instrument in global payments? And as financial systems become increasingly automated, what role could AI play in accelerating stablecoin usage? Lauren, you want to start with this one?
Yeah. So the AI world is very interesting. Obviously, it's changing very quickly. Cloudflare sort of made that use case where instead of paying your monthly subscription fee to the New York Times, you're actually paying by the sort of article you're reading. The X402 protocol is very interesting as a way or a foundation to do that. I think UCP from Google, Cloudflare will have one. There will be a bunch of these protocols that you can use to have an agent pay online for these kinds of scenarios. I think for stablecoins in that world, there's two things that make me believe stablecoins will sort of lead there. And I think I want to caveat that I think both of these things are 2 years out. Right now, if anyone in the room has used an agent to make a payment, I'm going to bet you've used a credit card because we're all building trust. We like the recourse, and that's fine. But there's a lot of B2B payments that would never be made on credit. And I do think stablecoins, so going into the two reasons why, sort of the data access that a blockchain provides to a business, when your agent is going out and deciding on a price or deciding on where liquidity is for an asset or where they can access, if a swap needs to be made, all of that data is public in blockchain. And if you do that in the TradFi world, obviously there's Bloomberg. Obviously you have your TMS, which could give you access to all of your banks and your FX desks that you're onboarded to. But you don't get the same global wealth of data to make a decision on. And that's going to be incredibly important for an agent, especially as the use cases get more complicated. You have your 24/7 real-time I love bringing up settlement. I totally agree. Many blockchains handle settlement really differently. The XRP ledger, for example, and part of the reason Ripple builds on top of the XRP ledger is it's one block settlement. So when the XRP ledger closes, it's done. You don't have, on Ethereum, sometimes you can have some custody platforms, you'll see 20 blocks, some custody platforms, you'll see 6 blocks, and settlement is a little bit different. Not to say things don't settle. Things definitely settle on Ethereum as well. But I think that type of conversation will continue to grow. And so agents will make decisions based on liquidity. And I do think that liquidity access in stablecoins, as the market continues to grow, will drive usage there. The last part I want to say, I'm really going on a tangent here, is crypto has always had a wallet problem. It's very difficult to make money in that business. I see this future where you hold your global currencies. If you're a global user, you have Euro, USD, what else, Singapore, you're making payments in these different currencies, and you would, as an institution, you definitely can access a multi-currency bank account, but you'll have to get access for your users. It's very different than in crypto, where every wallet supports that out of the box. And so I think when you're surfing the internet, and now all of a sudden it's not tangible walking into a store and buying. It's a global experience where you need all these different currencies to access even just different news sources. That will be extremely important. So I'm really excited to see that wallet experience grow.
Austin, you have any insights on this one?
I'll take the other side of the agentic commerce thing. I'm pretty sure agents doing a good job with that stuff, given how exploitable they are right now. As Tom said, I don't think speed's the main boundary there. And when somebody tricks your agent into giving them $5,000 for a license that doesn't exist, you're going to think harder about agentic commerce. Sorry about that, Alina. So joking aside, though, other than my hijinks online, I think where AI will actually be very useful is in the anti-financial crime efforts in this space. As I said, the data landscape is vast. Multi-source data is the way to go. If you understand things like Palantir, really it's a cross-data source interpolation that is finding most of, quote unquote, the good stuff right now. As people adopt these methods, you're going to be able to transact more places with more people with higher degrees of trust when you understand thinking around things like social graphs. And for that, you need AI interpreting large amounts of data as a first cut before you even get to humans. Like, the volume problem is too high otherwise. So ironically, like, we were talking about this before the panel starts. As a business school professor, you get to look at interesting things and say controversial stuff like crime is actually a pretty good indicator of utility and technological adoption, right? Because criminals have a lot of incentive to find new methods that work. But also that tells you that the then second driver of many of these things is the anti-financial crime efforts. And so I think that is actually where we're going to get the most traction. And the faster institutions understand how to do that, the more they're going to be able to use this stuff and outpace their competitors.
Tom, you want to add anything?
Yeah, I find the intersection between AI and programmable money just fascinating. And when it relates to stable coins, I see within the next 2 or 3 years, the volume is really growing exponentially, and that's largely driven by agentic AI. And I think that's going to create other problems for us, and I think we're going to have to try to process things faster, right? If you did 1,000 payments a day and you had a problem, with your regulator auditor, you're going to kind of reconstruct it and see what happened with that payment. When you have 1 million payments a day, you can't do that. And so I think part of the shift is going to be we're going to have to be able to do all the checks you need to check around the token, around the stablecoin, has to be done at execution time, at transfer time, and not kind of reconciled after the fact and after you have a problem, because it's just going to be too voluminous to do that. Now that actually creates 2 gaps right now. One is we need a lot of processing at execution time. Before you even get into zero knowledge proofs and that sort of thing, you need to process. Oh, and by the way, the world's in a memory shortage now. Anybody who deals with data center and hardware knows that it's much more expensive than it was a couple of months ago. It's actually, in some cases, hard to get your hands on. And this is exactly the time where you need more AI to be able to do more sophisticated things to check the transaction as it happens, not reconciling after you've had a problem. The second thing is we're going to have to make the tokens and the stablecoins much smarter and having much more information on them, so you can do those checks before they happen. Can I hold this stablecoin in Brazil? Which compliance checks did it actually go through? If I'm holding a tokenized asset, how does that settle? All of these things have to get worked out, and I would argue they're all going to have to be checked up front, because trying to reconcile that in the past or after things happen is going to be really problematic. And that's kind of a missing layer that I see right now. So I think we've got a huge memory problem at runtime and execution time, and I think we have a kind of missing governance kind of trust layer that's going to have to be added on to everything that we have today.
Yeah, I think 5 years from now, cross-border payments will look and feel like domestic real-time payments, like faster payments in the UK and PIX. It will be instant. It'll be very low cost, and it will just work. And stablecoins will be behind the scenes, being used for optimized transaction routing and netting and settlement of institutional balances between those participants in this payment system. And where AI comes in is crunching the massive amounts of data needed to optimally route transactions, to screen them in real time, considering correspondent relationships and net positions. We think about things like netting loops, so being able to net networks of obligations between 10, 15, 20 different institutions with a single transfer of value. Things like that will, enabled by AI, will make the costs and the FX impact of these types of payments drop dramatically and make them just instant and just work.
Perfect. Well, it looks like we're at time. We've covered a lot of ground today, from the value proposition of stablecoins, institutional adoption, regulation, and the evolving economics of global payments. What's clear is that stablecoins are no longer just a siloed crypto market instrument, but are increasingly becoming part of the global payments infrastructure. The pace of adoption will ultimately depend on technology, regulation, and trust, but the direction of travel is becoming increasingly clear. Lauren, Tom, Austin, James, thank you for the insights, and thank you all for joining us.